Good morning, we are Team 8 and we are Pepe Arumi, Alberto Bernal, Ton Huélamo and me, Blanca Artola. Today we are presenting our financial analysis and business proposal for opening a new Berria Txapela franchise in Barcelona, and we want to demonstrate that this project is a long-term valuable investment that promises sustainable growth and profitability. This is the index for the presentation. First, we will introduce the balance sheet, then the income statement. After, we will analyze the free cash flow to the firm, then the turnover, the ratios, and finally the net present value, the internal rate of return and modified internal rate of return, and the payback.
First of all, we're going to analyze Berria Txapela balance sheet. In the balance sheet, we can see that in the third year, the business will have a financial independence. In the gross non-current assets, there is a characteristic that shows us that the business is constantly investing in the gross non-current assets, what reflects that the business is in a continuous growth. What is growing too is the total amount of equity all over the years, which might be interesting for those who want to invest in the company. The variation in the operating working capital is minimal, which reflects the good management in short term resources. Now we can see the different graph from the balance sheet. The financial need that is going down, the regularity of the operating net working capital, the rise of equity all among the years, and now let's take a look at the income statement. The income statement of Berria Txapela shows us that from year 1 to year 4, there is an increase in sales. The gross margin also rises up every year. The company's activity is efficient and profitable, as we can see right here. Increment of EBITDA from year 1 to year 4, including the perpetuity, indicates the project viability. The operating expenses and the proportional to increase in sales, maintaining this cost structure will allow the company to maximize profit as it continues growing. The perpetuity indicates that the business can maintain EBITDA, EBIT, and EAT positive and stable all over the years. This offers a long-term profitability and a constant cash flow, which is crucial for a sustainable return. We can see here in the graphs that sales and cost of goods sold evolution, the gross margin and EBITDA, additional cost distribution, and the EAT evolution.
Now, I will analyze the free cash flow to the firm, which is an essential indicator for evaluating the company's cash generation capabilities. As seen in the table, from year 1 to year 4, operating cash flow increases from approximately 144,000 euros to 173,000, remaining stable afterwards. This growth reflects the company's operational strength in generating cash. The project requires an initial investment of 300,000 euros, with one third due by year 0 and the remaining 200,000 euros by year 1. Also, we have a consistent capex of 48,000, but rising to 55,000 in perpetuity. This suggests a focus on maintaining and enhancing infrastructure, ensuring operational continuity. Working capital investments decrease over time, showing improved efficiency and stabilized by year 5 at almost 8,000, allowing to allocate cash to other investments or shareholder returns. If we look at the graph, the free cash flow to the firm is negative in the first years due to initial investments, but becomes positive in year 2, reaching over 173,000 in year 4 and stabilizes at almost 118,000 from year 5 onward. This indicates predictable and consistent long-term cash flows. The terminal value in year 4 is around 737,000 euros, boosting the accumulated cash flow and reinforcing the company's value. This represents a strong base for potential significant returns to investors. Finally, the accumulated free cash flow to the firm reaches approximately 1,060,000 in perpetuity, showing the company's capacity to provide substantial long-term returns.
Analyzing the turnover, as we can see, the accounts receivable has a new value because customers pay in cash at the moment. This is very financially attractive because the business always will have a relation between the accounts payable. Then the amount of stocks remains partially constant among the years, as we can see in the graph, what gives us a sign about the warehouse control with the entry and exit of inventories. Then the accounts payable highlights an equilibrium among the years, what is a very interesting fact to maintain a good relation with its creditors and grow up the business. The initial investment concludes by the fourth year, as we can see it in the table, meaning that from that point the business can sustain itself through its activities. Finally, the payments are higher in the first years, however remain constant among the next years. This structure of payment shows a low-risk, high-efficiency model, designed to establish the business firmly in the early years and then maintain it sustainably. Finally, to sum up, for potential investors, this setup reflects a balanced approach to financial management, aiming for liquidity, operational efficiency, and predictable long-term cash flows. This balance may help in building confidence in the business ability to generate returns without excessive financial risks.
Regarding the financial ratios, they highlight the project's strong profitability, efficient capital use, and attractive potential return for investors. Firstly, we are going to explain the ROCE. ROCE measures the company's efficiency in using total capital to generate profits. We can see that ROCE improves significantly from year 4 onward, reaching 40.54% in perpetuity. This is attractive for investors as it shows that the company is effectively utilizing its capital, maximizing profits for every euro invested in operations. The next ratio is return on equity, which measures profitability on shareholders' equity. It shows a declining trend from 36.01% in year 2 to 8.49% in perpetuity. While this may seem negative, the decrease could indicate a stronger, less leveraged capital base. This means the company relies less on debt. Although the return is lower, the capital is better protected, which could appeal to investors seeking long-term stability. The return on assets demonstrate the company's efficiency in using its assets to generate returns. Starting from year 4, ROA stabilizes at 40.54%, indicating that the company's assets are producing solid and consistent returns. This efficiency in resource use is a positive sign for the project's financial health over the long term. Finally, the return on investment shows a significant increase, reaching 23.62% in perpetuity. This growth suggests that once the project achieves operational stability, it can generate strong and sustainable cash flows. This level of long-term return is attractive to investors, highlighting a good opportunity for consistent and durable profits. Relating to financial metrics like net present value, modified internal rate of return, and payback, these indicators collectively demonstrate the project's profitability, realistic returns, and capital quick recovery. The project net present value is 557,243.73 euros, which means that the project will generate a significant value above the initial investment cost, showing attractive profitability. The internal rate of return is of 73%, that is well above the cost of capital, which is 12%, indicating that the project is highly profitable compared to other investment opportunities. However, this ratio is not always realistic. For a more realistic perspective, we use MIR, which give us 56%, reflecting solid profitability even with conservative reinvestments, which enhance the project's long-term viability. The payback period is just 3 years, meaning investors will recover the capital quickly, reducing risk and increasing investment security. In summary, these indicators shows that the project is not only profitable but also offers a quick recovery and an attractive return. The MIR of 56% reflects solid profitability based on a conservative reinvestment rate, while the IR of 73% suggests potentially high profitability but is not as realistic as the MIR. With a positive net present value and a payback period of just 3 years, the project presents a strong investment opportunity. This combination of strong profitability, fast recovery, and sustainable returns makes this project an appealing choice for long term investment. Thank you for your time and attention. We look forward to the opportunity to discuss this project further and answer any questions you may have.